Making millions during a market crash might seem counterintuitive, but it's a strategy that has proven successful for savvy investors throughout history. While many panic and sell off their assets at a loss, those who understand market dynamics and remain calm can seize opportunities that arise from market volatility. This video will explore Peter Lynch's various strategies for capitalizing on market downturns to potentially grow your wealth significantly during turbulent times. Peter Lynch, often hailed as one of the greatest investors in history, is best known for his remarkable tenure as the mutual fund manager of Fidelity Magellan Fund from 1977 to 1990. During this period, Lynch achieved an astounding annual return of 29%, significantly outperforming the broader stock market and solidifying his legacy in the investment community. His management saw the fund's assets grow from a modest $18 million to a staggering $14 billion. Lynch's approach is particularly relevant in today's economic conditions where uncertainty and volatility are prevalent. Peter Lynch's investment philosophy is characterized by a few key principles that we will discuss throughout the remainder of the video. Learning from history. One of the most crucial aspects of making millions during a stock market crash is learning from history, a lesson emphasized by legendary investor Peter Lynch. According to Lynch, the stock market's historical patterns are critical to understand, and this knowledge can provide you with a significant edge in turbulent times. Consider this. Over the past 93 years, the stock market has experienced 50 declines of 10% or more. This means that, on average, about once every 2 years, the market undergoes a correction, a euphemism for losing a lot of money quickly. Corrections are a natural part of the market cycle, and while they can be unsettling, they are also opportunities if you are prepared. Even more dramatic are the bear markets, which are declines of 25% or more. There have been 15 such declines in the past 93 years, averaging out to 1 every 6 years. These significant downturns can be frightening, but they also offer the chance to buy high-quality stocks at significantly reduced prices. Here's what you need to keep in mind. Expect and prepare for declines. The market will go down at some point. If you're not ready for this inevitability, you shouldn't be in stocks. Understanding that corrections and bear markets are part of the cycle will help you keep a level head when others are panicking. This preparation is not just psychological, but strategic, allowing you to see the declines as opportunities rather than disasters. When it comes to investing, you must accept that the market is going to go up and down. Human nature hasn't changed much over the years, and inevitably, some unexpected event will come out of left field and cause the market to either fall or rise. This volatility is an inherent part of the market, and understanding how to navigate it can provide you with great opportunities. Volatility is not something to fear. Instead, it should be viewed as a natural aspect of the stock market. Markets will continue to experience ups and downs, and these fluctuations can be beneficial if you understand what you own. If you don't have a deep understanding of individual stocks, investing in mutual funds can be a good strategy. By regularly adding to your mutual fund investments, you can capitalize on the long-term growth of the market. Historically, corporate profits have grown at an average rate of about 8% per year. This means that, on average, corporate profits double approximately every 9 years. Peter Lynch believed that the stock market should follow this pattern, doubling roughly every 9 years as well. This growth is driven by the fundamental performance of companies, which increases their earnings and, consequently, their stock prices. Consider the current state of the market. If the market is at 3,800 points today, Lynch suggests you can expect it to double to 7,600 points over the next 8 to 9 years. This pattern should repeat, with the market doubling again in the subsequent 8 to 9 years. This long-term perspective is crucial for successful investing. Instead of getting caught up in the short-term fluctuations and attempting to predict the next 500 or 600 points, focus on the long-term growth potential of your investments. Historical patterns show that market declines and recoveries are cyclical. By understanding these patterns, you can remain calm and strategic during downturns. Knowing that the market tends to recover over time can provide you with the patience and confidence needed to hold on to your investments and even buy more during low periods. If you're enjoying this video, hit that like button, subscribe, and turn on notifications for more valuable content. Understand what you own. To take advantage of market declines, you need to deeply understand the companies you invest in. This means looking at their balance sheets, evaluating their business models, and assessing their long-term prospects. Lynch emphasizes that if you thoroughly understand what you own, you can be more confident during market downturns, knowing that the intrinsic value of your investments will likely recover and grow over time. To truly take advantage of a market crash, it is essential that you understand the companies in which you're investing in. This principle is critical because it provides a foundation for making informed decisions during periods of market volatility. Imagine you've bought a stock purely because its price dropped from $26 to $16, and then it fell further to $10. Without a solid understanding of the company, what would you do if it dropped to $9, $8, or even $7? This uncertainty is where many investors falter. They sell because they don't know why they bought the stock in the first place. When faced with continual price declines, they panic and make impulsive decisions. When you buy a stock without understanding the underlying business, you are essentially gambling. If the stock price drops, you're left without a clear rationale for your investment, making it difficult to determine your next move. Should you hold on, buy more, or sell? Without knowledge of the company's fundamentals, you're likely to sell out of fear, often at a significant loss. However, if you understand the company, its business model, financial health, and growth prospects, you're in a much better position to make informed decisions. Let's say you've done your research and you believe in the long-term potential of a company. If its stock price drops during a market crash, you won't panic. Instead, you'll see it as an opportunity to buy more at a discounted price. You'll know that the company's fundamentals remain strong and that its stock price is likely to recover and grow over time. Volatility in the financial markets can be unsettling, but it's also where opportunities arise. Understanding the companies you invest in allows you to remain calm during volatile periods. Instead of being swayed by market fluctuations, you can rely on your knowledge and conviction about the company's long-term prospects. If you like a stock at $14 and it drops to $6 during a market decline, this can be a great opportunity. Assuming you've done your homework and understand the company well, you know that its fundamentals are strong and that it's capable of rebounding. Instead of seeing the drop as a loss, view it as a chance to buy more shares at a much lower price. If your target was for the stock to rise from 14 to 22, then seeing it go from $6 to 22 is even better. When the market is volatile, it is important to reflect on your initial reasons for investing. If those reasons are still valid, consider holding or even buying more if the stock price has dropped. Review the company's financial statements, earnings report, and industry position. Strong fundamentals indicate that the company is likely to withstand market turbulence. Determine if the stock's price decline is due to broader market conditions or if there are specific issues with the company. If the decline is due to temporary market conditions, it might be a good buying opportunity. Additionally, remember your long-term goals. Short-term volatility is less relevant if you're investing for the long term. The principle of compounding is fundamental to long-term investing. By reinvesting your earnings and allowing your investments to grow over time, you can significantly increase your wealth. As corporate profits grow and stock prices follow, the compounding effect will become more pronounced, accelerating your portfolio's growth. Regularly adding to your investments, particularly during market downturns, can significantly enhance your returns over time. When prices are lower, your money buys more shares, setting you up for greater gains when the market rebounds. This strategy, known as dollar cost averaging, helps mitigate the impact of volatility and ensures that you're consistently investing in the market. Diversification. If you're concerned about volatility, diversifying your portfolio can help reduce risk. By spreading your investments across various sectors and asset classes, you can reduce the impact of any single stock's performance on your overall portfolio. While Lynch believed in diversification, he warned against over-diversification, which can dilute potential gains. He managed to strike a balance by investing in a wide array of stocks while still making significant bets on high-conviction ideas. Additionally, Lynch sought out companies with strong growth potential, often looking for those with a proven track record of earnings growth and the capability to sustain or accelerate that growth. Understanding the companies you invest in is crucial for taking advantage of market crashes. Without this understanding, you're likely to make impulsive, fear-driven decisions that can harm your financial goals. Instead, focus on thorough research and a clear rationale for each investment. During volatile periods, rely on this knowledge to guide your decisions, seeing downturns as opportunities rather than threats. By maintaining a long-term perspective and sticking to your investment strategy, you can navigate market volatility with confidence and potentially reap significant rewards. Remember, the stock market is inherently unpredictable, but with a solid understanding of your investments, you can turn this unpredictability to your advantage. Ignore market timing predictions. Another key strategy is to ignore market timing predictions. Many will claim they predicted the market decline after it happens, but often these predictions are numerous and inconsistent. Timing the market is extremely difficult, and Lynch advises against trying to do so. Instead, focus on the value and potential of the companies you invest in. Your ability to recognize good companies and buy them at discounted prices during downturns is what will drive your success, not trying to predict when the markets will fall. By learning from history and applying Lynch's principles, you can turn market downturns into opportunities. Expect market declines, prepare for them, and understand the companies you invest in. Remember, if you're not ready for the market to go down, you shouldn't own stocks. But if you're prepared and understand what you own, you can use these declines to your advantage, potentially making millions when the market recovers. Taking advantage of market declines requires a shift in mindset, from seeing downturns as threats to viewing them as opportunities. With Peter Lynch's guidance, you can navigate these periods with confidence and strategic insight, positioning yourself for long-term success. What do you do when there are market downturns? Share your thoughts below, and don't forget to like and subscribe for more valuable content.